Hi, my name is Ben Londergan. I'm the CEO of Group 1 Trading, and we're the designated primary market maker in VIX options. So in March, there was a very large price fluctuation in VIX. What that says to me about what investors were thinking is that a lot of the events, the situation in the Middle East, coupled with the earthquake in Japan and the potential issues with the nuclear reactor, had people very worried about the implications to the overall market. You saw some rather large moves in the S&P 500. Predictably, VIX jumped on that larger volatility move, and as things subsided and the situations in Libya and Tokyo and the nuclear reactor started to subside and the equity market started to rally, you saw a pretty significant decline in the price of VIX. My personal opinion or my feeling is that my answer would be not really. Things changed rather quickly and rather dramatically. The last couple of days we've seen the equity market either not move much or move up. To me, those are both consistent with much lower levels of volatility. I think one of the things to look at if you're looking at vol right now is really the time structure. The front month to me actually represents what I actually see happening in the marketplace, which was a very volatile market in March and a much less volatile market currently. And so I think that actually represents the current status of the equity markets and the S&P 500 quite well. What I'd be more interested in if I was looking at complacency was what's happening in the back months, and what you're actually seeing is a larger and larger spread between where people expect volatility to be in the short run and where people expect volatility to be in the long run, which tells me that while people are expecting low levels of volatility in the next 3 to 4 weeks, they're actually expecting volatility to go up in the longer term, which to me is not really consistent with complacency, but more consistent with the market taking a breather or stopping moving as heavily in the short run. So with all the price movement in VIX, what should investors be looking for in the near term? My opinion is that investors should be looking at two things. The first being the price relationship between the front and back month futures in VIX. I think if that spread continues to widen, where the front month futures are getting cheaper and the back month futures are staying at the same level, it will indicate that people are thinking the market is not going to move in the short run but has a larger potential for moving in the long run. The second thing I would look at is the implied volatility of VIX options. When the market was going crazy in the middle of March, you basically saw a rather large increase in the implied volatility of the options on VIX. That has come in a little bit since then, and if that continues to come in the longer term, I would expect it to mean people don't think VIX is going to move substantially, which would, to me, mean continuing more of the same with a upwards drift in the marketplace. So CBOE's listed some new volatility products. They're currently trading futures on gold volatility, and they plan on listing options on gold volatility in the near future. CBOE's also planning on listing futures and options on oil volatility, as well as some single stock names. This represents a really exciting time for trading volatility in that it will give you access to lots of different asset classes or lots of different buckets to trade in terms of how you can access volatility in different ways. You can hedge different parts of your portfolio using volatility as a trading instrument. One of the important things to look at when you're looking at the new volatility products that are going to trade on CBOE is that they're going to look a little bit different and behave a little bit differently than VIX on the SPX. The rationale there being that the shape of the volatility curve for the underlying product is going to look a little bit different than it does in the SPX. For example, right now, the volatility curve in gold could probably best be described as a U-shape. And that's actually much different than what the volatility curve looks like for the SPX. So to some extent, price moves in gold are going to cause the volatility of gold to behave differently. Another thing that's important when you're looking at using gold as an example, when you're looking at a commodity, is that commodities have very different price behaviors than something like a stock index, where there may be lower bounds or perceived lower bounds to how low they can go, and as they approach those lower bounds, volatility will actually come in as the commodity trades lower, which would be a much different price behavior than you would see in the S&P options, and therefore the VIX gold or gold VIX options would behave much differently as would the futures.